Welcome everybody to the Thursday edition of the Not Your Average Investor Show. Today we have the JWB Guest Investor of the Week.
Week.
I'm your host, Pablo Gonzalez. With me as always, the man that I affectionately like to call GC because he's got these genius concepts, knows how to generate cash flows. He's a great co-host. And his name happens to be Gregg Cohen. Say hello, Gregg.
Hello, everybody. Great to be with you.
With us, as always, is our amazing community manager. We call her MTM because she likes to bring us the moments that matter and because she's known as Madison the Magnificent. Say hello, Madison.
Hi, everybody.
And our guest investor today, the star of the show, coming from Southern California by way of Europe. Not your typical investor story, not average in the least. He's got a portfolio in Florida, in Texas. He's got short-term family rentals. He's done flips. He's got syndications, and he is here to share massive value. Kyle, I should have asked you how to say your name. Atanasov.
Yes.
Yeah.
Nailed it.
Kyle Atanasov, yes.
Atanasov. All right, man. Welcome to the show, Kyle. It's great to have you, my friend.
Thanks for the invite. I'm glad to be here.
Awesome, man. You know, we're not gonna do it. We're not gonna launch this as we normally launch it. We're gonna jump right into it to make the best use of Kyle's time today. But if you are joining us on the YouTube live stream, if you are listening in the podcast, if you are watching later on YouTube, there's a little trick to really enjoying this show, and that's jumping in, being part of the community. And you get to do that by joining us live on Tuesdays and Thursdays at 12:30 Eastern by going to where, GC?
NYAIS.com.
Oh, I like how you paste that. And what happens when you do that?
When you go there, you get to be part of the cool club here, the live audience, so you can be a part of the chat. You can get yourself a nickname. Pablo will probably butcher your name like you just did to our good friend Kyle at first. And you get to be part of the
roll call, baby. We got our leadoff hitter today leading us off.
John Henning, of course.
John Henning. We've got our friend from Germany with a Guten Tag.
Mr. Denny Davies.
Mr. Denny Davis. We got the MVP of the community.
Lee Bishop.
We got somebody that likes to check in with a Feliz Propiedad del Día de la Semana.
I love it. Welcome, Bill Shields. That's awesome, man.
Bill Shields in the house. We got Michael Santorios in the house. Welcoming everybody.
Machine.
The referral machine.
Michael, I was just checking your returns on investment last night. I was checking your private lending and your turnkey properties, man. You're crushing it, my friend. Doing great, man.
We got Joe B1 Kenobi in the house.
Joe Bussy.
GC, you want to turn on the lights over here?
Oh, yeah.
We got Greg number one. The better Greg.
Greg Stone, of course.
Greg Stone, howdy from New Jersey.
We
got the ringmaster in the house.
Andrew Barnhill.
We got the second family of the Not Your Average Investor Show, Gary and Rosalind Riley from Marietta, California. We salute them. We officially salute you.
Okay,
we salute you from henceforth. Who else we got in the house? We got Big Papa. We love when Big Papa calls in.
Pops, what's up, man?
Greg's dad, Jay Cohen. We got the man that everybody knows in California.
Noah Randari
in the house. Who else we got? We got my favorite name to mispronounce from Milpitas, California.
Lewis Hudnell,
fellow Steeler fan in the house.
That's right.
Laura Colby from Washington. Is that a new name?
It's not a new name.
Not a new name.
But she doesn't show up often, so it is wonderful to have
you in the house. Good to have you in the house. We got somebody checking in from the first time. If you check in with your phone, you're automatically defaulted to Not Your Average Guest, so I don't know your name. So you just got to let me know who you are. You just dropped an emoji. Welcome to the show. Happy to have you in the community. We got our favorite name to pronounce, Aaron O'Neill.
Into the lights.
Good to have you in here, Aaron O'Neill. And we got our favorite person from Atlanta.
Eddie Harris? All right, I didn't see it. I'm like, who's from Atlanta? Eddie Harris.
Checking in from Atlanta, Eddie Harris. Let's jump right in. Kyle, we just teased this thing. Oh, LaToya, good to have you.
All right, LaToya.
Welcome to the family. Hope you make a place here. Kyle, we teased this a second ago, right? You don't have the average investor story. You're not the average Californian tech bro that just came into a whole bunch of money. You've been scrapping your way to like 20 properties. Give us the background, man. How have you built up this impressive portfolio?
Yeah, I'm happy to. So I moved to the States in 2005, literally with $0 in my bank account. And I kind of worked in the restaurant industry for the first few years and kind of built my way up to as a project manager for a hospital, which is kind of still my day job as we speak. But interesting enough, we met a person, and I don't even know this person's name, and we don't keep in contact anymore. In 2009, at the restaurant, at kind of the place that I was working, she did mention to me, "Hey, man, I know you're from Europe. You're hustling. you should invest. And I didn't know anything about investing, let alone real estate. But she put the book in my head, and I started reading some books and I started reading news. And fair enough, I pulled the trigger, and me and my wife, we bought our very first condo in Vegas in 2011. Interesting enough, that it was $25,000. We bought it all cash with kind of our own savings. And we didn't know if this is a good investment, but my thought process is, if this is a place that person can live and it costs less than Honda Accord,
Yeah.
the average car, there's no brainer.
Right.
We rent out the space for $800 back then. And I was like, yeah, that totally makes sense. So I started looking at the numbers. So we scraped to save a year later for another condo. As you know, and kind of probably everyone knows at this point, that Vegas was the market that was hit the most after 2008. And literally those condos, they used to sell for between 150 to 200K. They went down basically for $20,000, $30,000, $40,000.
Mm-hmm.
So that was kind of the very early stage of my investment career and real estate. Looking back, it was one of the best possible moves that I can have done, and I'm happy I did it.
It's incredible, Kyle. I'm always curious about what clicked in your mind to make you take massive action to start to buy a condo at a time in 2009 and 10 and 11 when it was tenuous as far as real estate. I mean, people in this country didn't know if real estate was ever going to recover. And you were new to this country, and you had the strength and the courage, and you had something else. Like, what clicked for you mentally to say, wow, this is a step that I want to take? What was it for you?
This actually might help me a little bit. I didn't know what I don't know, right? I mean, sometimes the people, when they have a big experience, they kind of tend to go back and kind of rewind in their mind. I didn't know what I don't know. I just follow my gut and basically I'm pretty good with math. I'm kind of very analytical, and to me, it just was no brainer. If I can buy something for $25,000, and if I can rent it for $800 a month, and it's in a desirable location, and I know that this asset used to cost $175K just 4 years ago, to me was just, it makes sense. And also, I was looking around my friends and my peers, and most of them, they didn't either invest, or they invested in stocks with minimal return or saving account. So to me I have to do something different. I can't be part of what everyone else is doing. And again, looking back, maybe you can call it luck, because I didn't really have a big mentor. So I kind of mentor myself initially. And obviously there was a great time to buy in 2011 and 12. I didn't know at the time. Now I know, of course.
Right.
But interesting what you mentioned. When we bought our first condo, me and my wife were still renting a studio in Los Angeles. So we didn't have a place for ourselves. We were renting a very small studio, but we decided to buy our very first investment property. So that's kind of untraditional in my mind. So that kind of helped us a lot. When we start investing with more properties, just keeping our expenses low and kind of keeping our debt to income ratio low kind of help us to, maintain and get a lot of those 10 golden nuggets of loans that if a lot of people, when they buy primary residence, especially if it's expensive, they're kind of maxed out of their DTI and they can't really qualify any further.
I mean, it's something else, Kyle, because another thing that first of all, we love it's something we've been keying in on more, right? Like, the opportunity for real estate in the United States is unique to the rest of the world, right? With that, I also know that kind of like when you're not from here, people that are not from here tend to have more of a saver mentality than people from here, right? So like, you're kind of expressing that already. But the other side of that is the idea, this like fear of debt, right? Like, for us, debt was very foreign to us when we started getting into rental properties. You bought your first home for 25. Was that something that you saved up for and paid cash, or were you already understanding debt? Can you kind of tell us the evolution of kind of like your understanding of debt not being from here?
Yeah, so I came from a very kind of not a wealthy family at all. So I was afraid, and I'm still afraid of a bad debt, but I was fortunate enough to learn the difference between good debt and bad debt. On your question, though, initially when we moved and kind of start working and saving, we were just saving because we didn't know what we're saving for, but we knew that we kind of have to save and kind of have our initial seed capital. So our very first property, we bought it all cash. So basically, these were our savings for 5 years. So we saved $25,000 and we bought a condo all cash. That was our very first investment. All other investments, they're leveraged. So this was basically our very first and last property that we ever bought all cash.
Nice. And first you bought in Vegas, still living in LA, pretty close, right? And the numbers penciled out. Can you talk us through how did you go from like investing in Vegas, which was a couple hours away, to investing all the way down the I-10 corridor and get to Jacksonville?
So this is an interesting story. So initially when we bought the condo and then the next year we bought the second one, we managed everything ourselves. We just didn't know any better. And looking back, of course, that's not a best use of our time. However, I think especially for the investors that they want to be a little bit more hands-on, it's a great experience, right? I mean, I wouldn't want to manage property anymore by any means, but having this experience of kind of managing property and kind of driving to Vegas and kind of, we build a lot of confidence and experience that otherwise we wouldn't. On your question, so once we kind of had this knowledge and we knew that we're on the right path, numbers works, the return works. This is when we start kind of looking this more in a professional way. With my wife got a real estate license. She became a real estate agent with Keller Williams. Later, she opened her own brokerage. Me, on the other side, I started listening to our podcast, kind of socializing with the local investors to the local meetups. One of them, his name was Bruce Norris. Some of you might have heard his name. He's the one actually that kind of pointed out at 2014 or 15 that Florida is the state in general that it's worth looking for many, many reasons on macro level. And then he went down to kind of nitty gritty, even to kind of break down Florida, Southern Florida, Northern Florida, Central Florida. So he's the one that kind of spiked my interest in Florida. But by then I already kind of knew that I don't need to invest of where I live. And frankly, I did start investing. Even my very first investment wasn't where I live. So I felt very comfortable investing out of area and out of state. So basically, to me, it was about numbers. It's kind of everything pencil out, the analytical portion. And as soon as it was convinced and the analytical piece of the investing works, then I moved to the second kind of big milestone, which is finding the property, finding the team.
I feel like can you break down how, so there's Florida, right? And then there is Northeast Florida, right? Like, and I think that you had some really good points in the pre-call of kind of like how you see the state and the attractiveness of what you're investing in. Can you share that with our community? How, you're an analytical mind. How'd you analyze it?
So to me, and that's kind of my take, Florida in general, it's Miami and everything else. That's kind of one for first kind of big differentiation. And when I say Miami and everything else, Miami is it's a cosmopolitan city. It's like New York, San Francisco, Los Angeles. A lot from everything basically. So you can really kind of classify Miami as a certain type of city. But the rest of Florida, kind of a lot of people go there to retire or go there to take vacation and kind of have fun, which has nothing wrong with it. It's amazing. The weather is amazing, except the hurricane season, right? But what I personally, kind of my personal investment philosophy was, I want to have a sort of predictability, again, kind of coming from more kind of analytical background. And I knew what happened in 2008, and I knew cities like Orlando and Vegas, which are more kind of entertainment and kind of vacation-oriented type of city. I know what happened with them. So I kind of wanted to be hedged somehow against this. And I kind of landed on North Florida and kind of whole Jacksonville area in general as a sort of a hybrid city of it's still Florida, it's still nice weather, it's still people go for vacation there, but also there's a lot of business businesses, a lot of young people, which was kind of different than a typical Florida city. So to me, I always follow the businesses and jobs and kind of the growth. And kind of back then, again, that was 2015 and 16, Jacksonville came as a city that has potential. And I kind of decided to ride the way.
You're not the only one who's seen that potential from investors and also people moving here. That's why we're the 5th fastest growing population in all of the MSAs in the country. Jacksonville is number 5, which surprises most people. So
It has been for like the last 10 years.
Yeah, I was just looking at the data yesterday, and it's been that way from 2015 to 2019, 2017 to 2019. Little old Jacksonville, which was kind of a sleepy town for a lot of years. People didn't really talk about it, but Kyle saw it. Kyle, I would love to know a little bit more too, and I think this would really help our audience to know the progression. Getting to 20 homes is incredible. And I would love to know kind of the timeline. How long did it take you to get to your 5th home? Did you speed up from 5 to 15 or was it slow and steady? And then how many homes do we manage for you at JWB? And when did you get to Jacksonville? Was that the first city you went to after Vegas? Can you kind of give us that progression there?
Yeah, happy to. So let's see. So we have total of 14 buildings, and they are basically equal to 22 units.
Mm-hmm.
And right now the portfolio is Texas and Florida. In Florida, we have strictly in Jacksonville and Jacksonville Beach. And in Florida, we have in Texas we have in Austin and Houston. So in Texas, we have 4 single-family homes. Everything else is in Jacksonville and Jacksonville Beach. We have basically one investment in California. It's in Palm Springs, and this is short-term rental. It's Airbnb.
So is that 5 or 6 stores that you have here in Jacksonville?
So in Jacksonville, in Jacksonville we have. So you guys, JWB manage sort of 3 buildings, sort of 4 units.
Okay.
For me. But also I have a small multifamily property in Riverside, a 12-unit building. And also I have a standalone short-term rental in Jacksonville Beach.
Fantastic. So you are an incredible wealth of knowledge for how different property management teams perform. And I'm sure you've seen some really good examples, and I'm sure you've seen some really bad examples. Our audience is, one of the things they struggle with is, how do you find the team to support you, right? How do I know that this team can support? It's one of the biggest, things that holds people back before they invest with JWB or in real estate. What would be some lessons that you have learned along the way of what a good sign that you have a great property manager is versus one who's just not worthy?
Yeah, probably the audience heard this many times, but JWB, you guys are kind of vertically integrated company, which is something I always kind of looking back from the other property managers, when property management companies vertically integrated, that's a good sign right there. That's a big plus. Usually what I kind of learned from my experience with dealing with the property managers in Texas and kind of different cities in Texas, and is I stay away from, I call it a franchise property management companies. They are usually profitable for the owner, but they're not really profitable for the owner of the franchise, but not really profitable for the owner of the property. And I had my fair share of kind of dealing with this through my learning process.
What's a sign? Maybe what specifically, and you don't have to name names, but what specifically did you notice in that relationship that you'd say, I'm never doing that again?
A sign, they're not proactive. They are to me, again, I'm kind of from my analytical background. Usually when I invest and underwrite and kind of do my due diligence, I always look ahead of what will happen in a year, in 3 years, 5 years, 10 years. And I've learned that this property, and again, I'm not saying that all franchise property managers are bad. I'm sure that there's a fantastic ones. It's just the ones that I come across. They don't look long term. They're look ahead is literally with the next month just to collect the rent. They're not proactive. They don't do a lot of proactive maintenance and preventive maintenance, and it shows. The pro forma or the performance might be amazing for the year one, and then And then year 2 and 3 and 5, kind of you see the negative incline because you miss this opportunity to do the preventive maintenance, take the extra step to reach out to the tenant, to ask for feedback, and kind of those little things that they add up. It's compound effects, right? If you do things, even in incremental steps, if you do things well, it will incrementally kind of compound in a good way, and then it's same apply for a negative, and then it will basically.
It's kind of like death by 1,000 cuts of just lack of proactivity. Do they typically sign 1-year leases?
1 year, correct.
They only sign 1-year leases. Yeah, we hear that a lot.
That's marketing with JWB that you guys are pushing for 2 years, sometimes 3 years, and also you have escalation clause, which something I think is the right thing to do, and it kind of fit with my vision and my underwriting assumptions, so it kind of works really well.
It's a focus on the long term. I mean, the best way to be proactive about avoiding maintenance and vacancy costs is to sign your residents up for a long-term lease and treat them like gold.
When you said vertical integration, right? Like based on our conversation prior to the show, I get the sense that you're not on these Zoom calls every single week. You might, you listen to Keith Weinhold and you listen to other podcasts, but the term vertical integration is something we started throwing around about like a year and a half ago, 2 years ago.
Mm-hmm.
And Greg and I were like, vertical integration, it's so valuable. And yet I still look for signs of when somebody echoes that back to us. What do you mean by it, right? Like we know what we mean by it, but what do you mean by vertical integration? Why is it valuable?
Oh yeah, I mean, to me, how I see things is, I'll give an example of not vertically integrated companies. If I have a franchise, and if I open a franchise in LA and then one in Palm Springs and then one in San Francisco, that's to me is horizontally integrated company. You're just creating a small hubs in a kind of many areas of your state, or maybe even go out of state and kind of create mini hubs in many places, versus vertically integrated to me is you just stay within one area, within one city, and then you just drill down and you kind of extend your services, and you guys you're building a platform, basically building new homes. You have your construction company, you have your property management company, so you have a lot of silos within the companies, but they're all focused on Jacksonville and Florida, which kind of to me it's a big plus compared than having a property management company that just, again, it's a franchise and they're really there for a short term, not for a long term haul.
You just made my day. You really did. So, for so many years, and I've got baggage with this. This is going back years and years and years, but when I was back on the phones bringing clients on board, I would remember people saying, "Oh, you're only in Jacksonville? Oh, I wish you were in all of these markets." And I was like, I don't think you're getting it. The fact that we're in one market is incredible for you. That's how I can create the best experience for you and the best risk-adjusted returns. But I would constantly get met with, "Oh, I wish you were in these markets." And I was just waiting for the day. This was many years ago. I was like, one day I'm going to talk to a client and they're going to say, "I love the fact that you're just in Jacksonville. And I think it's better for me. And I wish everybody would just focus on one market." And Kyle, today is that day. Thank you, brother.
You know what they say, jack of all trades and master of none. So that kind of apply to you guys. Doesn't apply to you, but some other property management, they go everywhere, but they're not specializing in one thing. And to me, it's going back to the book of one thing, right? It's you focusing on one thing and one city and kind of one strategy, and you kind of master this strategy and you just try it.
Kyle, I know that you got to go in 3 minutes, and once you go, community, we are going to go into like the Madison Shares News. We got some good stuff to share today. What are we not asking you about before you get out of here? Kind of like, what is something that you would like to share with folks of, based on your experience, things to look for, how to get started, anything that you get asked a lot that you think people misunderstand?
Yeah, and I think I didn't answer fully one of the questions that Greg had, is kind of how my portfolio compounded, and it's really kind of a lot of people think that's kind of a get rich fast type of thing, and it's not. The first 4 years we had those two condos, and then And then we moved the next 3 years, we acquired 3 more properties. In the next 3 years, we didn't really acquire anything. We were doing some flips and kind of building more capital until we were able to refinance some of the properties and kind of take cash out refi, basically and redeploy the capital to additional assets. Then we sold our condos and when did 1031 exchange for houses. And then in 2021, we took advantage of the low interest rates and we refinanced everything. We did absolutely everything. And we took kind of got a chunk of capital and we redeployed again and in assets. So literally in 2021, we double our portfolio. So what we built basically from 2011 to 2021 for 10 years, we double it within a year. So that's just an example of it's a slow game and kind of people have to be patient and you never know when you're kind of when the time will come and when the interest rates will be low or high but it just comes to show that it's a boring game. It's a long game. It's a boring game, but it's rewarding and you just have to be patient.
Well done. Well done.
Yeah.
I feel like Kyle's just like entered my brain this entire call and just
from the beginning.
Yeah. And it's been very similar to my journey when I started in 2006. I wrote down some words here: slow, steady, discipline, right? Long-term, stay in the game, and you wake up 10 years down the road, 15 years down the road, you control your time, your financial goals are accomplished, and it's not about get rich quick. It's about time in the game. And you just got to find a great team to be able to allow you to enjoy this asset class for that long.
Yes, yeah. That's not the last thing I would say. It's not a game that you can play alone. It's a basically a game of relationships, partners, and as long as you have the right people around you and you surround yourself with the right people, whether listening podcasts, meetups, property managers, real estate agents, it's a team sport.
Kyle, I've taken a bunch of notes of stuff that you shared. Gregg and I are going to break it down now here for the community. I know you got to go. This was super, super valuable. Even these 30 minutes, I think you hit on some amazing points that I think we want to recap now and just kind of get in an open dialogue, man. But I'm going to let you go. Thank you so much for doing this, right? Like taking a half an hour out of the middle of your day. I know you got a bunch of other things to do. It's early over there. So thanks a million. Any kind of last words you want to sign off here with us?
Thanks for having me. And if someone have questions, I can share my email and you're welcome to connect with me. And I'm happy to chat about real estate. And it's kind of, I'm always up to chat about real estate. And I like to kind of connect with people with like-minded mindset. So feel free to, and this is not just for everyone in the community. Feel free to reach out to me. And I'm happy to connect.
Do you want to put it in the chat, Kyle, before you get out of here? I know Juan Jose has some specific questions about property managers and stuff like that, and maybe they can reach out to you there instead of just putting it on blast for the rest of the internet. Unless you want to say it out loud here, that's fine too.
Well, I'll just type it in the chat.
Cool. Sounds good, man. Sounds good. All right. Ask Kyle. You want to say goodbye to Kyle there, Gregg? And then we'll start kind of discussing all the other stuff that we want to recap here.
Yeah, just super appreciate your time. And Kyle and I got to know each other 5 or 6 years ago. And so we haven't spoken in that long. So it's just incredible to see your success and love that, we get to be a part of it. But more than that, it's really impressive how you have built this thing, even beyond the numbers that are your doors and your financial success. So congratulations to you and your family, and can't wait to see you again soon.
Thank you very much.
All right. See you, Kyle. All right. That was awesome. I got at least 4 or 5 different things that I want to hit on with UGC, but we skipped a big part of our call, something that I like to call my favorite part of Thursdays here. Can you guess what that is?
Oh, I know what it is.
It's when Madison shares good news. Madison, what is the good news?
Hi, everybody. I had some good news lined up that I wanted to share, but I'm changing it because something really, really cool happened this morning, and I think we should share that instead. We had the opportunity to gift a house to a veteran. This morning, all of the talk about the golf tournament and raising money and all of your help donating to JWB Cares paid off this morning when Kyle, his name was John,
Emily, and And I remember the
It's
dog's
Henry.
name now.
It's Henry. Yeah, that's where my mind went, was the dog. But the three of them got a whole reveal for their brand new construction home in a cool area. And it was really heartwarming. All of the JWB teammates that were there, even the K9 for Warriors, were just on and on about how cool of an experience it was. And it was really heartwarming.
This event, and Madison did a great job sharing this good news, sharing what we experienced here. But, you know, unless you've had the opportunity to give a big bear hug to somebody who just received a brand new home, and they're pouring their heart out to you, thanking you, right? Unless you are there, you can't possibly experience how moving it is.
Yeah.
And it is something we've had the opportunity to experience now as our team has done this 5 years. And, you know, the conversation with John, you know, as he said, you know, this is changing my life. He said, you know, he kept saying, oh, I don't deserve this. And what we kept saying is, you do deserve this.
Yeah.
No one else does, but like
Yeah.
you do.
The way he not only has served our country, but he is a beacon for hope to ending veteran suicide. So he does deserve it. But we talked about how to expand that hope in this fraternity that we have now. There are 5 families in Jacksonville who have brand new construction homes. And
Starting basketball team.
There we go. We got a starting 5 now. And, you know, and that's what Madison and myself and Pablo and our entire team wanted to communicate with you. You all are making that happen. When I came to you guys and I said, hey guys, I really want us to raise some money so that we can build this house this year. You guys donated $2,500 in like an hour. You know, you guys in the community. And it's not just you guys, it's the entire team and our network. Together, we raised over $200,000 to change somebody's life. Man, and it's incredible.
Yeah, it's amazing. When you sent the email out, right? Like it's like a handful of folks get to go. You can't have all 100 team members out there. And I was lucky enough to receive the invite. I know that you reached out to me privately, like, hey man, I know you got a lot going on. You don't totally have to be there. And I was like, you don't get the chance to witness somebody's life being changed in an instant very often. And you can't say no to those opportunities. And for me, the big lesson is lives get changed all the time, right? The ability to do it, know it's coming, do it consistently, do it 5 years in a row, doing it in a time when the real estate market is down and things are real tough and people are getting laid off all around this industry, and yet still be able to deliver a home to a veteran that deserves it in this long-term partnership via a community-wide effort, to me is this like incredible sign of deliberate leadership, long-term thinking, culture, right? Like all the things that I really believe in, that I really admire out of JWB, and to get to witness it and get to do it every year the way that y'all do it is just like a phenomenal thing, man. Just a really magical moment.
And something we're really proud of, the ability to do it consistently 5 years in a row. You know, we're really proud of that because this is our mission. Our mission, we happen to sell rental properties and do property management, and, you know, we happen to manage investments, but that's not why we're here. We're here to change people's lives.
Yeah.
And if you're only thinking in your own business or in your own job, if you're only thinking about the activity you're doing, no matter how great you are at it, it's going to become hollow, right? This mission for JWB is what keeps our team fired up day in, day out for 17 years and for another 100 years. It's because of moments like this. So as much as John and Emily felt like we were giving to them today and everybody did give so much to them, they are that epitome of what our mission is. And we get to have that beautiful memory for this year and for many, many years. And then next year we'll get to do it for another family as well. So amazing day.
You know what I call that? I call that good news. Thanks, Madison. That was awesome. All right. So let's recap some of the stuff that we just went over with concept. We got some breaking news too, GC. Big announcement.
Oh, you just switched it up on that, man. You faked the funk on that one.
Flip it on you, dog. I flipped it on you. Flip mode.
Well, we've been sort of teasing this thing that you and I, a little pet project we've been working on for a little while.
Here and there.
Just sprinkling it on a little bit here. Why don't we come strong now? Tell them what we're working on.
Let's come correct.
So we've got our official launch date for the Not Your Average Investor course, which is teaching you the smart way to invest in rental properties. This is a course that Pablo and I have been working on and have built over the last few months, and it is designed to help all of you who are in that phase of mastering this asset class, whatever phase you're in, right? You might be very new to it. It is there for you to learn the nuts and bolts of this. If you're a little bit more advanced and you want to see how to do this at a high level and to do this passively, this course is there for you as well. So our launch date is coming up. It's on May 22nd. So mark the calendars down, May 22nd. We're going to be launching it, and we're still figuring it out, but we're going to take care of our Not Your Average Investor community one way or another. So don't you worry about that. So we'll give you all the details and all that. It will be a paid course, but don't worry, we're taking care of all of you guys.
Yeah. So super pumped to launch this thing. We've been working real hard at it. Ton of fun to film, right? Like I've got like a whole sizzle reel of like outtakes of me and GC acting, just fumbling on words or making fun of each other in between the takes.
That never happens.
That never happens, but super pumped to launch it. Super, super pumped to get it in your hands and get feedback on it, right? So like this is version 1. We put a bunch of work into it, but like everything that we do out here, you're the one that makes it better, right? So like we want to release this to you. It's going to be free to the Not Your Average Investors community when we first launch it, because what we really want is some feedback, how we can make the next version even better. So May 22nd, circle it. It's under 2 hours total, the course, right? But
in little like 5-10 minute segments.
Yeah. A to Z. It's going to be really enjoyable. It's well animated. GC comes at it with his best thoughts. I do my best to be entertaining in it as well. So can't wait to launch that. Can't wait to get your feedback on it. And I'm excited, man. I think it's going to be a new era.
I love it.
Yeah. Awesome. All right. So now GC, let's recap some of the stuff here from Kyle. Tons of gold nuggets. I'll go first.
Okay, go for it.
First thing that I want, and I'll do one, then you do one. How about that? What do you think about that?
Mm-hmm.
I'm going to talk about my favorite subject.
Okay.
Networking.
Okay.
In Kyle's story, you heard a ton of this idea that it was like, got to Southern California, saw what was working for people, saw what wasn't, listened to podcasts. His friend Bruce Norris telling him about Florida, right? Like it's clear to me that deep into Kyle's journey was this idea that he got surrounded by people that were doing this thing that made a lot of sense to him, that showed him a way of breaking out of the rat race and not being average. And anytime I hear that, I like to call it out, because it is basically what we are doing here. We're trying to surround ourselves and you with a community of folks that have experience in doing this and that, and investing in long-term rental properties and being able to give you context of the difference between short-term rentals or Texas or Florida,
right,
or whatever it's going. I feel like that is something we hear all the time. And every time I hear it, I want to call it out. It is surround yourself with people that give you the good kind of cognitive bias that you're able to do this type of stuff.
I agree. And I go back to the inherent challenges that Kyle had versus others. There's a million other people that are exposed to the same things as Kyle was, but he had this ability to take action. And this was 2009. 2009 was a tough time to get excited about real estate.
Yeah, totally. Even 2011 was tough, man.
It was tough. Yeah.
I remember around that time, it was like, oh, we've hit the bottom, I swear.
Yeah. If you weren't in this game, you did not understand how this asset class work over multiple market cycles. Very few folks were looking at that and saying, you know what, I see an opportunity here. So big ups to Kyle and his wife for that. The other thing was just thinking about, how difficult it was to get access to the network and to get access to a great community and to get access to this type of information in 2009, right? 2006 is when I started. I had to physically go to a Jacksonville real estate investors meeting. And that was my only hope for being able to talk to anybody who shared the same interests that I had. Yeah. And that was once a month. And I brought my A game for that, hour-long meeting. And I was like, I'm going to network with everybody and try to take them out to lunch, right? Yeah. When I think about it now, pre-Facebook, right? There was no Facebook groups.
Yeah.
So I kind of land in this place now. Now, if you see this opportunity and something is holding you back from taking action now, you have no excuse, in my opinion, right? Clearly, we love you being here on the show and the podcast and YouTube. Hopefully that's how you're listening, all those good places. But you have access to education, information for free now, right? You can jump on the phone and talk to my team who manages $800 million of single family rental properties here, right? You couldn't just do that back in the day. You just didn't have access to that back in the day. Yeah. You don't have to spend a dime, right? So I want to put that out there. I think Kyle is super inspiring. And for those who are just, you want to do it, but you're just not taking action, like, I think it's time for a reality check, right?
Yeah.
It's on you,
I think so, man. I think one of the big lessons, kind of like when we finished the class, was this idea of like next steps. Obviously, go to our Facebook group, go to Not Your Average Investor Show Facebook group. If you're listening to this, join the Facebook group. But I really do think that there's a real inherent value of going to chatwithjwb.com, like no matter where you are on your journey, getting on the calendar, right? Like if you have to surround yourself by real estate experts, I think it's a good opportunity to just go to chatwithjwb.com, schedule a call, and just start the conversation of like, hey man, maybe this is for me in 3 years, but like, what do I need to know that I don't already know, and talk to a real human being about it, whether you're DMing or on a phone call. Like, I think it's a worthwhile thing.
Agreed.
All right, your turn.
A couple of things.
Start with one.
All right. So I think it's really cool to show how somebody can leverage JWB or leverage a property manager in a different way than we normally talk about on the show.
Okay.
Like shining a light on Kyle and his wife, who are super experienced and want to be more hands-on, but want to take advantage of a market. They leverage JWB just for the property management services. Right? That's not something we've talked a lot about extensively.
And we didn't specifically talk about it on the show. Why don't you give some context?
Yeah, absolutely. So, when Kyle and I were actually on the phone together 5 or 6 years ago, I was working with him to understand if buying turnkey rental properties for us was the right move, or if property management was the right move for him. And what we collectively decided is that investing in turnkey rental properties with JWB was not the right move for Kyle. Because Kyle wanted to be very hands-on. He wanted to be in a lot of decisions. And, everything else worked as far as him being a client. We loved Kyle, and we love working with him now. But we collectively said, you know what? Because you want to be in the nuts and bolts of it, why don't you do that? Acquire the properties and then bring them to JWB, and then we'll be your property management arm. And for somebody who is experienced and wants to take that extra time and wants to take on that extra risk of doing all those other things other than property management, it can work. About 25% of all the homes that we manage, that's a significant number, right? We manage 5,000. So that's a significant number.
More than 1,000.
There we go. So 1,200, 1,300 homes that we manage are from property management clients, just like Kyle, that don't actually buy the property with us. So I thought that was really cool to shine some light, because there are so many ways that you can leverage a world-class team in a market that you want to invest in. And it's not just one size fits all with the turnkey approach.
I love that you shared that, because MVP Lee is in the chat saying, wait, what? It's like, now that is quite an amazing statement for JWB to say to a client, right? Like this idea of like, hey, maybe it's not right for you to just buy this thing with us. You want to be more hands-on, go and do it, but we can still help you on this other side, right? Like, I think that's really illuminating. If you want to be completely passive, you don't want to think about it. You just, like you understand it's like team and market, and then property is a widget. But if you want to take a step further and you want to really like handle the acquisition yourself, you are a real estate professional, then there's another way to service that and still fit into the vertical integration piece and still benefit from that. I think that's really cool. All right, let's talk. I want to bring that up, right? I love that he said vertical integration.
That was amazing.
That was amazing. Yeah. So,
and he doesn't listen to the show, so it didn't come from us.
Exactly.
Which is great.
Yeah. Yeah. And to me, what I took from that, it's something that we say often, and he said it better than us. He said, when I'm looking at companies that aren't vertically integrated, maybe year 1, maybe year 2 is okay, but at some point it starts to become a crappy experience.
Right.
We talk about that a lot in the class. We talk about it a lot in the show, this idea that you buy the property once and people are so fixated on it, but you're going to own it for 10, 20, 30 years. So it's like, you want to make sure that in year 6, when there's something happening, you're not sitting at the dinner table saying, but honey, I bought this thing. It was so good when I bought it. Right. You want to be thinking, but honey, we have the team that's going to take care of this. Like we have the trusted partner that even though there is this like one thing that's happening, we're in good hands. And that idea of thinking beyond year 1, 2, or 3 and thinking long-term, he brought it up himself, long-term thinking. That is the sign of, being with a good partner, being in a vertically integrated environment. And that's what he looks for. I thought that was pretty cool.
I did too. I mean, Kyle to me just evoked calm, steady, discipline, right? Strategy, right? These are the character traits that help you win in investing overall, and definitely when it comes to rental property investing, right? It's not out there to try to find the best quick hit return on investment in 1 year, right? It is thinking about, how am I going to enjoy this asset class for the next 10 years? That's the standard of teammate that Kyle's looking for.
Yeah.
And when you do that, Kyle said it as well, it's hard to lose in owning single family rental properties when you're in the game for a long time. And that's why finding a team and a situation where you're going to enjoy being in the game for 10 years is the most important thing. That's why you should start number one, finding the team.
Finding the team. All right, what you got? What else you got?
Yeah, I thought when we asked Kyle, what was that thing that clicked, right? Somebody who's not from this country, who had no background in real estate, right? He had a conversation that sounded like with a server at a restaurant, and he, within a few months or a year or whatnot, owned his first rental property in a market where he didn't live in 2009, when people were definitely calling him crazy. Like, what was that? And he said, I'm analytical. I looked at the numbers. I said, if this thing is providing value in housing for somebody at $25,000, this has to make sense over the long haul. To me, what that also meant was he understood the 5 profit centers. He understood the 5 profit centers. The combination of buy and hold and the 5 profit centers are what motivated him, as somebody who did not have a penchant for going down this route, to change his whole investing strategy over the course of one conversation with a server. And now he has 20 rental properties and has accomplished his financial goals. So I think a commitment to understanding all 5 profit centers is paramount. You're not going to love this asset class until you get it. And you only get it when you understand all 5.
That's a good one. Yeah. I would add, he's analytical and he had some real gumption to take that move, right? Like, it's like he had, believe what you see, right? Like, believe the thing that you see. So many people will get caught up in but not for me.
Yeah.
Right? Man, I really, really admire that. I got one more. How he went from 1 to 22, I think, is another story that we talk about a lot on this show. The idea that, man, just getting in the game opens up these other levers, right? Like, we talk a lot about this, like, under promise, over deliver in the asset that you're delivering. And therefore we very much don't talk about the idea that, man, once you're on base, right? Like, once you're on base in this game, these avenues open up. The fact that, like, he can go from 1 property to like 4 properties with the money from that property within a couple of years, because you start to get like that, the appreciation, along with like the debt pay down, along with the cash flow that you make, all of a sudden opens up these levers to then go get more debt on this property, to then go acquire other assets. Our stories we've heard from Hervé, our stories, we hear that from a lot of people. And it's something that, quite frankly, I'm in it for, right?
Mm-hmm.
Like, I very much believe that these 3 properties I've bought over the last year and a half, I'm going to turn into 6 properties within the next 5 years without coming out of pocket a lot of money.
Mm-hmm.
And that, to me, is another part of the bonus part of real estate that we talk about, every once in a while. And we're careful to talk about it because we want to under promise and over deliver. But these externalities that come from just being in this from a long time, I think it's a great thing to learn from him there.
Yeah. It's like, to me, I think of it in terms of kind of maturing in the mastery of this asset class, right? We first have to understand, how important the team is, then the market, and then the property, right? We have to understand the 5 profit centers. That's sort of baseline for having success here. And when you understand that, now we start to be where kind of you are right now, where you've got your portfolio, and now you really start to supercharge it through refinancing, cash out refinances, potentially 1031 exchanges or whatnot. You're becoming more and more of a financial engineer. And that's what I love.
I love that too. Chris Locks, who is, I think, a new name here. Welcome to the show.
All right, Chris, welcome.
Yeah. He's starting with JWB Property Management on Wednesday, and he's pumped.
Oh, love it.
Also has a question. You missed it. What are the 5 profit centers, GC?
Glad you asked, Chris. Number 1, net rental income. Number 2, tax savings. Number 3, principal pay down. Number 4, home price appreciation. And number 5, inflation, hedging, and profiting. There are your 5 profit centers.
Look at Mr. GC answering stuff directly.
I knew you like that.
I did. So those are the five profit centers, right? We talk about, right, like the net rental income being at the end of the year, how much cash you receive versus your expenses.
Mm-hmm.
People tend to really overvalue that. But the reality of it is the idea that if you're in it for a full market cycle, the majority of the profit is going to come from the home price appreciation, right?
Mm-hmm.
Like when we do these breakdowns of people's portfolio, you see home price appreciation as the Pac-Man of the pie, and everything else is the mouth of the Pac-Man. But you want positive cash flow in order to be able to like last that full market cycle.
Exactly.
So it becomes that tax savings comes from the depreciation side of the materials inside the home, essentially.
Yeah.
And what you can do there, that pay down is that idea that Tim Hicks made famous on the show when he was talking about your resident is paying off this loan for you as time goes on. And that's a really nice high floor.
Mm-hmm.
And we call inflation hedging the most popular profit center of 2023.
That's right. It wins the award after being dormant as far as being talked about for 100 years.
Cool kid on the block. Cool kid on the block. Nadeem Shah's got a question in here in the Q&A. How long one has to own the property before one can do a 1031 exchange? What does Gregg suggest?
It's 1 year. You have to own it for a year before you can do a 1031.
Any more context there? I feel like is kind of like as far as like strategy goes.
You want a more expounded answer there, Pablo? I'm happy to give you a more expanded answer.
On me, please.
A 1031 exchange is a wonderful strategy. What it allows you to do is to defer the taxes that you would have paid on the gains of the sale. And why this is important is because instead of paying the taxes when you sell the property, that money that you're no longer paying Uncle Sam can be used to buy more properties, can be used to invest in other things. And that's the beauty of a 1031 exchange. You can sell something. You don't have to pay any profits on the gains at that moment. You keep kicking that can down the road, right?
Mm-hmm.
Keep kicking that can down the road. Kicking that can down the road doesn't usually have a good terminology to it, except when you're talking about paying taxes. You want to kick that can as far as you can, and that's what a 1031 allows you to do.
Kick that can as far as you can.
There you go.
Listen up.
You know the funny thing? We make fun of my business partner, Adam, our CEO,
Mhm.
because he takes commonly said things and he just misses a word.
Yeah.
So you could see how I was kind of like stopping before I said, kick that can down the road.
Yeah.
He says, kick that can down the river. Which I don't know who kicks cans down rivers, but it's totally messing with me because I'm pretty sure I'm going to say that on the show here.
I find that I get much more roll off of my kick when it's on a hard surface, and on the river it tends to.
It just stays there.
It just stays there.
You're paying taxes if you're kicking the can down the river in this instance.
Also, not a fan of littering, so it is what it is.
There you go.
Don't want to get it into water source. All right, GC, do you have any other takeaways, man? I feel like this is a good kind of like wrap up there.
Yeah, you nailed what I was going to talk about there at the end there. That was awesome.
Give a last little piece of content, because I feel like the chat blew up when we're like, oh, you can do property management with JWB, but without of it. Just give a little quick rundown of when it makes sense to do that versus turnkey, and kind of like where does JWB manage properties?
Yeah, it comes down to largely two things, right? It comes down to how hands-on you want to be, right? If you are that type of individual who wants to be very active in the construction process, if you want to be very active in the acquisition process, if you want to have your hands in all of that because you feel like you can drive value for yourself there and you have the desire to do that, that's probably a better fit for the property management client relationship. You can go out there and source all of your inventory yourself, and then you can come to JWB where we will do the professional property management for you. So that's one instance. If you are just more hands-on, you want to be in it, you're probably better suited to be a JWB property management client. And then the other one would be if you buy in places that we don't buy. Like, for example, Kyle was talking about owning properties in Jacksonville Beach, right? I love Jacksonville Beach. I live really close to Jacksonville Beach, but I'm not bringing you properties in Jacksonville Beach because they don't hit our criteria. And they can be wonderful investments, but it's a different criteria that Kyle has for that part of his portfolio. They don't produce positive cash flow. They don't pay for themselves each month because the prices are too high and the rents don't support positive cash flow. So that would be another example. If you really want to acquire properties on the beach that are higher priced and won't cash flow, well, we're not going to have that inventory for you. It's not our model of workforce housing, but we will happily manage that property in a professional way for you to be able to drive value there.
Cool. Last thing, where does JWB Property Management, where do they not? Chris Lux is asking, do you do Section 8 housing?
Section 8 housing can be an asset. It's on a case-by-case basis, so we're open to it. The reality is it's a very small percentage of our inventory. I think it's about 7 or 8% of our homes are through Section 8. There's a lot of misconceptions about Section 8, though, so I don't want to completely shut the door on Section 8. It can be a real asset for you as an owner of rental properties, but largely it's better for those bigger homes where the vouchers for those homes, which are provided by HUD, are sizable and that can support the positive rental income, the positive cash flow that we're talking about. When you get into smaller homes, we find that sometimes the voucher amounts don't support the rent that we need. So it's more about that. And then there's the other part of it, which with Section 8, there's just more red tape. So we weigh, okay, well, is this worth it to have this sit an extra month while the Section 8 process has to get approved and all of this for our clients? So we use it on a case-by-case basis for our clients. It's very infrequent, though. And like I mentioned, less than 10% of our inventory.
And territory-wise, where do you say yes?
You mean like neighborhoods?
Yeah.
In all 4 neighborhoods. That's a misconception. People think that HUD only happens or Section 8 only happens in certain lower income neighborhoods. HUD vouchers are accepted anywhere in Jacksonville. And you just have to match where the voucher amount can match the market rate rent for that area. So it's all neighborhoods.
Got it. And what I was asking is, where does JWB manage? Like, where will you accept a property management property at? Like, what are the geographical boundaries that you cover if somebody wants to be active and acquire their own properties and then give you the management?
Well, we are much more expanded than where we will provide turnkey properties, of course, because we have focused on those 4 neighborhoods as being the best risk-adjusted returns for our clients. We're much more expanded. So there are parts of Jacksonville that we will not manage properties in for anybody. And that's, we're a city of 1.6 million people. Every city that has, a million and a half people has some parts of town that it's not okay for us to put our team there. So there are some neighborhoods, those neighborhoods happen in different parts of the area. So it's not like I'm going to call one area of town a place that we won't manage. It's largely knowing within a certain area, what are some streets, what are some little pockets that we're not going to go. So, but overall, we're pretty open to managing properties. It's more about the relationship with the potential client coming on board. We have a livability standards. It's very important to us that we're creating housing opportunities for folks that are within our idea of what livability should be. We don't want to be slumlords. We won't be slumlords. And so it's more of a conversation of, how do you view this? Is your property up to our livability standards? Beyond that, most of Jacksonville is in our purview as far as managing property management clients, with a few exceptions that we would be able to work through very quickly. So if anybody has any questions, or if you're wondering, if property management might be the way to go to work with JWB, you can go to the same place, which is chatwithjwb.com, schedule a time, talk to our team. You can also go to jwbpropertymanagement.com. This is a cool tool. We don't talk about this often, but if you ever are curious about what your home could rent for, we have a tool there that tells you what JWB's homes right in that area are rented for. It's a market comparables tool for you for property management. So you can go to jwbpropertymanagement.com, put your information in there and find out what we would rent that property for.
Cool. So Chris in specific, who has a Section 8 house that he already owns and just wants to know exactly the property, that's a phone call, right? That's a get on chat with JWB, make sure it's a culture fit.
Absolutely.
Make sure you have the right expectations, jump on. So if you have a specific question, you already have it, for property management, go to chatwithjwb.com. Otherwise, in general, if you have a property in the Jacksonville metro area, right? Some parts of Clay County, some parts of, what's the other one?
Well, there's Nassau, there's Clay County, there's St. Johns County.
Cool. Nassau, St. Johns, Clay County, worth a phone call if you want best in class property management, vertically integrated. GC.
We did it, buddy.
Great show, buddy.
This is awesome.
Great show. Over 45 people here. Middle of your day on a Thursday. We never take it for granted. Just you, the community, you're the reason why we do this and the reason why we love it. So thank you for taking time out of your day. Big show coming up on Tuesday.
Yeah, we do.
What's on Tuesday?
It happens once a quarter. We've got our quarterly call, our quarterly Jacksonville real estate market update. And the last one was the highest attended show we've had
ever
in years.
Yeah.
And I just think it's such a cool time to have complete transparency with you all to show you the data on what's happening in prices in Jacksonville, what's happening for rent prices in Jacksonville, what's happening for months of inventory, What are our thoughts about where prices are going the rest of the year? How have our predictions worked for what we said last year to this year? So I'm excited. It's going to be a great show. We'll see you guys there.
It is always the most attended show every quarter. It's the most downloaded podcast. It's the most viewed YouTube video every single time we do it. So you want to be there, right?
Absolutely.
Because the cool kids are doing it.
And you'll get an email invitation. If you're a client, you'll get a special email invitation as well, in addition to the, reminders that we have for our normal shows for those who are not clients. So everybody, I'm going to hang out. It's going to be a party.
Love it. So thank you for being here. We'll see you for the Jacksonville market update on Tuesday. And in the meantime, just if you want to be like Kyle, just one thing that was very clear is that dude is not average. You do the same. See you on Tuesday.
See ya.